more, I
So, but
guess.
there is, okay, so I'm gonna
This is
talk about this in discrepancy, and there was a question here, I think it was from Nilesh. Are there any discrepancies between, let's say, the relative strength line and the comparative analysis? There could be one. The thing is, when we are comparing the low to the low, we cannot take the data point of the close, and this is what it is. This is the relative strength line based on the close. What we should do when we compare the low to the low is to compare the actual data for the low to the actual data of the low as well. So, for instance, the close here is at this level on this bar, but the low of that bar is here. So you could see how different the measurement could be. And I want to make this note for you because this is going to be important for those of you who's going to actually codify this. And we've had a student, Howard, who actually not just codified this, but he created an indicator that was available on TradeStation. And you still can go to our website, and under the tools, you could find his work. And actually today I'm going to show you some other things that he did for us. Okay, well, let's say that maybe at 1 we are somewhat weaker than the market. Okay, then what about 2?
so previous high to 2. I mean, that's definitely less steep. So Home Depot definitely looks stronger.
3,
Yeah, same thing. Home Depot's stronger.
4,
Home Depot's stronger.
5,
Stronger.
6.
Uh, uh, yeah, I don't know. Let's see. At Home Depot looks stronger.
Okay, well, if we are
I
in,
mean,
let's use relative strength. Okay, let's do
yeah,
this.
it's hard to tell on that one.
Okay,
Yeah, just barely. Yeah,
barely. Yeah, but stronger. Okay,
yeah,
7.
stronger. Yeah. 7 to 9. Yeah, so going to be stronger, or 5 to 7. Excuse me. Let's see, 5. Yeah, you have to draw that one out too. It's hard to tell.
Again, this is just,
Yeah, really tough.
yeah,
Yeah, really.
okay, well, let's just say equal. Okay, 8,
Let's see, 6 to 8, definitely stronger because that one's sloping
9.
down. Oh, definitely stronger. Yeah, market's actually sloping down. Yeah.
And we look at the relative strength line, and from this low to
Yep. Yep.
9, I mean, like, what do you guys see?
That's a
I mean, with,
no-brainer.
yeah, it's an uptrend. So the stock is outperforming in this area everything that the market throws at the stock. And there's just a sustainable short-term uptrend of the relative strength line and sustainable uptrend already of the price. We just have not overcome the long-term resistance. So the biggest question in this area, looking at all of the elements of strength, what does it mean for us in terms of how we look at institutional participation? Are they present? And if they
Yes.
are they buyers or sellers?
Yep.
What do you think, Adam?
They are definitely buyers here.
They're
Yeah.
definitely buyers. And then the next question, are they aggressive buyers or just maybe like usual type of buying activity?
I think they're, I mean, if you, 2011 was one of the most complicated years for the market because of, all the issues with 2011, but they're buying here. I mean, the market was in duress between July and the rest of the year, and Home Depot is going up. I mean, they're buying here. I would say fairly aggressively.
Fairly aggressively.
Yeah,
Why? Because look at the sequence of this strength.
yeah,
It suggests that they are buying on the rally and they're not selling on the reaction. Buying on the rally again to outperform, not selling on the reaction. Buying more on the rally, not selling on the reaction. Buying more on the rally, not selling on the reaction. This is very aggressive because it's consistent. It's a consistent buying, probably also on the way down in this zone. This looks like a value zone. So they are aggressive buyers. If they are aggressive buyers, so institutions are aggressive buyers, What does it mean for the supply? Supply, go ahead.
Yeah, yeah, just saying, yeah, it's being absorbed. I mean, supply is moving into institutional hands, and prices are going to ultimately keep going up pretty nicely.
Yeah, if supply is absorbed, remember guys that story about the ice cream? The more we sell, the more supply goes away from us, and the more that supply lands into the hands of the CO, of the composite man. Now, the composite man is not interested in selling this supply in a month or two, or even a year if the prospect is really good. They're going to hold on to that supply, not present it to the markets, and then as the price starts to perform better, that's going to attract other institutions. Those are institutional trend followers, and they're going to say, well, this stock performs so well, let me get more stocks. But there is not a lot of availability of the supply at this point of time. So they will have to auction for to get the shares of the stock, and they're going to go into the auction scenarios where they will buy the stock at the higher price, like it's shown here. This is all buying on the way up. It's more subtle because the volume signature is going to be less. Majority of the institutions would prefer to get in on the liquidity, but this defines a lot of the institutional presence. They are buying, and they're consistent and aggressive buying, which, by the way, Adam, should lead to what kind of long-term effect? Would the stock outperform long-term?
Yes, absolutely.
Yeah. So
Yeah,
long-term outperformance, that's what we should
yeah,
be expecting. So with
yeah.
this long-term outperformance, we would be thinking investing, long-term position. We could still do a swing. We could
Mhm.
do a swing trade because short-term also defines outperformance. So we should be in the stock in a swing as well. And look at the relative strength trend. I mean, this is probably one of the most persistent relative strength trends that I've seen.
Yeah.
Just goes up and up and up. It doesn't go into extreme overbought or extreme oversold. It's just very sustainable. The reactions are really small. All right, Adam, thank you.
Yes, you bet. Glad to help.
All right, so let's look at the next trading range here in 2013 and 14. And by the way, yeah, this is the reaction that we were looking at. Right, and we said we've seen the same elements as we've seen on the reaction 2008, 2009. So 2008, 2009 defines more of the long term. 2011, 12 defines more of the timing for the short-term cyclical low. Look what happens next. They wanted to be in this position. Why? Well, because it's so valuable to them. They see a lot of future valuation in higher prices, so they want to be in that position before. And look at the run from 30 to 80, more than doubled on that run, and overcame a long-term resistance. And you know, the price requires, or rather the stock requires such behavior by institutions where they're seeing aggressive buying, and that would suggest that if we're going to have the rally, we might actually overcome the high here. So there are a lot of concepts that are tied together here where we look at the relative comparative performance, and we could deduct the way, the character with which the price is going to move. We could deduct the timing of when the price might leave the trading range, and we also could speculate as to the short-term and long-term uh, performance. All right, let's look at 2013-2014 range. And here is the next question. We look at the price of the stock on the daily, and we look at the relative strength ratio line. And this is also based on the daily. We see that the price just basically consolidates. It's a trading range. but then the relative strength is actually going down. So the question that I have for you guys, and I want you to answer this, write it down in your answers, in your questions box, why the relative strength line is trending down? What's happening here? Okay, some answers are coming in. The market is moving higher at the faster pace than Home Depot. Difference between the slopes of the trading ranges, okay, which is basically the same. Slope for the stock, slope for the market. Underperforming the market on the up move. Yes, all of you guys are correct. Look at this, higher highs, higher lows, and even though Home Depot has the same type of structure, higher highs, higher lows, but still Home Depot is predominantly in the trading range. The market is going up in a more sustainable uptrend than the stock. The stock is just consolidating mostly. The market is trending up. So if the market is in the uptrend and the stock is in the trading range, then what is stronger, what is weaker? Obviously, the market is stronger. Therefore, the stock is weaker, and on the relative strength trend is going to be shown as lower highs, lower lows, despite of the prices being in the consolidation for the stock. It's not about the structure of the price that would define for us the relative strength of the stock. It's the structure of the price relative to the of the stock relative to the price structure of the market proxy, in this case, spiders. So when we look at the market and the market is uptrending and the stock is just consolidating, then the stock is weaker, behaving weaker. The price of the stock is behaving weaker than the price of the market. And therefore, relative strength is going to be in the downtrend. But something significant happens later on. We've talked about two ways of how institutions can accumulate. They could accumulate through the trading range, or they could accumulate aggressively on the way out of the trading range. And we're seeing that there is some kind of aggression with which the price moves up out of the consolidation, and how the relative strength breaks the trend and creates a major sign of strength on both. And in a lot of cases, this is going to be a characteristic of phase D. We might have a reaccumulation where the price just spends a lot of time. Institutions are kind of, not interested at this point, and that leads to some kind of short-term capitulations within this structure, where weak hands are giving up their positions, and then suddenly when supply is so low, that's when the price starts to move up, and institutional trend followers are starting to get into this position. And that defines the move of the price, and that also defines the move of the relative strength line. Such aggressive buying, pushing the price higher, suggests urgent accumulation, suggests that they want to be in this position, suggests that we are going to have an uptrend, the timing is now, and this is a potential stock that's going to outperform. And that's exactly how it happened. All right, a homework. A homework is going to be 4 slides. On each slide, you're going to have a market proxy, S&P 500. And I'm going to show you this S&P 500 at an important swing top or bottom. meaning that if this is the top, then the next move is going to be to the downside. If this is the bottom, then the next move is going to be to the upside. So I'm effectively giving you a bias definition for the next swing. Your task is to look at the stock or stocks and choose at the market top the stocks that are in the distributional or redistributional structure, that are in phases C, D, O, E, and that have comparative advantage over other stocks to be a leader on the way down. At the market bottom, you just basically doing the opposite. You want to define the stocks that are going to be in the accumulation or reaccumulation range, that will be in phases C, D, O, E, and that and their comparative analysis suggests that they're going to outperform the next move up when the market resumes its swing. That's the whole task. Let's look at this. All right, so here are 4 stocks, or the 4 charts. Here is an S&P 500. This is, I believe, 2011. You don't, you can have this information, but it's not really that necessary. I'm showing you that this is the market top, and that the next swing is going to be to the downside. So if the price is going to go down, the question that we have is stock number 1 going to be the best stock to pick for a swing to the downside? Or is it going to be stock number 2? Or is it going to be stock number 3? Or maybe all of them? You will have to show me. You will have to conduct structural and comparative analysis. Combine them together and make your selection as to the stock, or maybe multiple stocks. Any questions on the homework? And you have 4 slides here. So in this case, the next bias is to the upside. We know that the market is going to go up. So which stock out of 3, or maybe multiple stocks, that you will be buying, that you will be selecting as your buy? Okay, next one. And one more. All right, well, let's see some questions, some comments. Okay, a question from Nilesh. Is comparative analysis useful to identify distribution of leading stocks with upsloping trading range? Okay, so let me just go somewhere else. We're looking at this scenario. Let's say this is a leadership stock, and we have higher highs, higher lows. How would the relative strength behave? It just depends on what the market is doing. So I can't really answer this question until we actually see what the market is doing. Let's quickly do that. What if the market is flat? Is the stock stronger or weaker at this point? Yes, the stock is stronger, because the stock is making higher highs, higher lows, the market is flat. Okay, how about this? The market is doing this, effectively in the downtrend. Is the stock stronger or weaker? Stronger, absolutely. Okay, how about this? The market is going up in line with the stock, so same structure. the stock is stronger or weaker? Same structure for the market. So stronger or weaker? The same, right? So the stock could behave the same way comparatively as the market. And the relative strength line is just going to be flat, nothing else. And then let's say that the market is just going aggressively up and the stock is going up, but maybe not so aggressively. So the stock is going to be stronger or weaker? Weaker, yes. So here are 4 scenarios that we have to think about before answering the question, whether they're, comparative analysis is going to be useful here defining the distribution, because usually you're going to be having a lot of troubles with the high highs, high lows in the distribution. It's going to look like a reaccumulation. This most recent drive to the downside into the December lows, such a great example of that, where we could have stocks like Navadia, leadership stocks, having this pattern right here of higher highs, higher lows, and then suddenly on the sign of weakness, an LPSY, they lose all of the leadership characteristics and then they become weaker. So effectively think about what we just did with Home Depot. In some of the cases, we had a weaker long-term picture, and then suddenly the stock is starting to behave much better. Strength suggests some buying, and that suggests that there's going to be a short-term outperformance. Well, the same on the opposite, the mirror side, of the trading range, that's going to be a leadership distributional range with higher highs, higher lows. Once on the sign of weakness, we see a lot of weakness. This is where it suggests that there's going to be a short-term underperformance, where the stock is going to go down much faster than the market. So sometimes I would say that the stock is outperforming on the downside. This means that the stock just travels to the downside much faster, and there is more selling for the stock. So it just depends. It really, really depends. It's also contextual as to where we see the signal, where we see that relative underperformance. One of the things that with the relative performance is that when you look at the relative performance, look at the price as well. And both of those have to confirm what's going on. And we'll do an exercise on this where we are taking the relative strength in the price, and then we're confirming the signal of the relative strength with the signal of the price. So we want to see the synchronicity. Okay, next question. Okay, for Forex traders, how can we make relative comparative analysis as you show in this webinar? How can I deduct if some euro pair example, let's say euro against Canadian dollar, is underperforming or outperforming? Okay, well, you guys know that I've traded Forex. So one of the things that I've been using is in Forex, you really have to think about the pairs in terms of correlations. Meaning that a pair like euro dollar, well, actually, let's say euro dollar or pound dollar most of the time are going to be highly correlated. So from this high correlation, which you could track using some websites, you can go to those and you can find like at this point of time how the two currency pairs are correlated. Is there a high correlation or low correlation? And by the way, there is, a cyclicality in the correlations between the pairs. You have to study that as well. But let's say that we've defined that these two are highly correlated. So what you're gonna do with this analysis is that you're still gonna have two charts, and they're gonna look somewhat the same because those are gonna be highly correlated instruments. But at some point, a stronger pair is to be bought, and then a weaker pair is to be sold. And you could use this strategy in both, let's say, pair trading, or you could do more of the directional trading. What do I mean by that? In the directional trading, let's say that you define the bias as an uptrend. So then your selection is going to be the strongest of the pairs. And you would just disregard the second pair. In the pair trading or spread trading, you could do this. You could literally buy a stronger pair and then you sell weaker pair. And the beauty about this is it makes you somewhat neutral to the directional bias. So in a way, it's almost like you're taking the same asset because this is a highly correlated asset. You define which asset is stronger. You want to be in that asset because the idea here is that the stronger asset is going to produce a better effect than the weaker asset. It suggests that institutions are more interested in that pair, so they're going to go for that rather over another pair. So your uptrend in that stronger pair should show you an outperformance. So it could look something like this. A stronger pair might look something like this. And then a weaker pair will look like this. So this spread, initially you're gonna take the spread out, right? I probably should have done it like this. Yeah, let's do it like this. So this spread right here is not gonna move a lot. But then the spread between these two currencies are gonna increase, right? So spread is increasing. And effectively, this is how you're making your money. It's on the increase of this spread where because of the outperformance of the first currency, there's going to be more interest and more push. And then in the currency that was weaker, there is less interest by institutions to be in the uptrend, so they will be less active, and that's going to create that spread. So you could benefit from the spread, taking away the directional bias and taking the directional risk away. You could do that. Okay, so that's great. What else? Okay, Philip is asking. So this is how we use the comparative analysis in practice. We identify the probable leader and then wait for phase C or D. Is that the only use? Well, yeah, definitely. We are in the trading range. There is not a lot of use for us right away if we see that there is an outperformance in phase A. Yes, it does suggest that maybe we are in the accumulation, that there is some interest by institutions, and potentially this could be an absorption of the supply that we observed in phase A. But we still have to go through phase B and then go into phase C, and we still have to define what kind of relative strength performance we have here. What if in phase A there is a lot of strength and then it just goes away? Again, we don't know. That's why market is so uncertain. We can't really predict what's going to happen next. So we have to always observe and then make a decision. And if we see enough observational points in phases B, C, and D, that would suggest that institutions are present, they are aggressively accumulating. This is the stock that we're going to pick. And obviously, phase C and D are crucial to us, so this is where we would be looking at the relative comparative performance. Okay, well, let's look at something different. Let's think of the presence of institutions through the composite man accounting. And then we're going to convert that into the concept of a sweet spot on the comparative performance. And again, this is just an attempt for us to understand what institutions are doing, how they're behaving. So let's go through this. This is a schematic that I've created for you guys with a hypothetical behavioral patterns that I'm showing here through buying and selling of the shares by big institutions. So let's go through this. In the downtrend, on the way down, at the point of the climactic action, the stopping action creates fear in weak hands, so therefore they are dumping their supply. Supply is increasing, but at the same time, because of this liquidity and value, institutional demand increases. And that's what stops the price from moving further down. Institutions are absorbing the supply from weak hands relatively fast, and that stops the price from moving further up. Their subsequent buying pushes the price up, and short professional traders covering their position also producing a lot of buying behind that, and that pushes the price up and creates an automatic rally, which is such a different look from everything what we've seen before. All of the attempts to rally in the downtrend, they look different than an automatic rally, and therefore we call this a change of character. So it's at the selling climax where there is so much liquidity and there is so much value. We, as the CEO, would establish our first position. Imagine that we're CEO. And imagine that CEO needs to accumulate 1 million shares in this particular stock. How would they do this? They can't buy everything right away. They're going to come into the point of the liquidity, establish this position, and then maybe even at the top, they're going to just profit take some of it. And that's going to push the price down, or maybe they are going to be inactive. And with this inactivity, the weak hands would not be able to sustain. They move to the upside, and the price will start deteriorating to the level of the support, where the CEO would buy again, add to the position, just because this is the zone where CEO would be buying. That buying diminishes the supply, suggests a rally. The rally comes to the high, to the resistance. The CEO might take a profit again. And I see this over and over again. I see how, in a lot of cases, the CEO type of institutions, they are willing to take some of the profits because it just stabilizes their equity line. and they are in more favorable situation if the price goes down in the reaction. The next support level, phase C, into the spring, this is where locally supply is going to increase. So CO is going to step up and buy the last number of shares from weak hands, and that would diminish supply even more. And that would suggest the timing. Supply is in strong hands, or the majority of the supply, or significant supply is in strong hands. And now if the CO is buying more, then the price is going to start moving up much rapidly, much faster. And at this point, CO might be buying on the way up, and it can't hide it anymore. So we'll see that first rally as a sign of strength rally, and by the time the CO is done with this rally, a lot of the positional sizes are quite significant. So we could be at the 800,000 number of shares at this point. So think about availability of the supply. It was just bought throughout the whole trading range structure in the sign of strength rally. Absorbing the sellers that were available throughout this whole structure. So with that, as the absorption of supply and absorption of sellers has happened, what kind of reaction we're going to have here? Well, probably not of the same quality as we had prior in the trading range. We're talking about a smaller reaction that's probably going to come into the area of the support we checked before as the resistance. So for the first time, we're going to have a precedent in the trading range where there is a sequence of buying and selling, a sequence of buying on the rally and the not selling on the subsequent reaction. This sequence we're going to call a sweet spot. Well, what does it tell us? It tells us that as there is interest on the way up by institutions to buy, and there is no interest to sell on the way down, the stock is ready right now to start moving to the upside. And this could define the timing for us as to when we should be getting into this position. Let's look at the distribution. And the same behaviors by institutions here. So their goal now is to get rid of 1 million shares. How would they do this? Well, they want to do this on the points of excitement, right? So for instance, into the climactic run, they can sell 500,000 shares, get rid of 1/2 of the position. Maybe they're even selling on the way down. Remember how a lot of the stocks would see a lot of distributional characteristics in phase A, and that would be even a reaccumulation. So we just have to know that at some spots, some institutions will sell, and then we will need to define how aggressive that selling is. Does that change overall bias for us or not? And then in some cases, as they sell, they're going to buy just a small position back just for the prices to stabilize and to push the price closer to the previous resistance. And that action is going to repeat itself until the CO is going to find the opportunity to sell the majority of its supply, and maybe even establish some positions to the downside, maybe short selling. So here's how CO gradually gonna distribute the stock. And obviously this is all in theory, this is just how I view this, and this should be a little bit more updated as to how this happens. But I want you to remember a couple of things. CO composite operator, or the composite man, is of large quantity. The size of their portfolio is tremendous. So therefore, they cannot move in and out of the position quickly. They have to spend some time accumulating the stock or distributing the stock. Because of how they do this, the stock might experience some relative or comparative performance issues, like starting to underperform. And if together with the price we see that deterioration on the relative performance, then we could potentially say that we are in the distributional formation. Performance by itself, underperformance by itself, does not suggest the bias. It just suggests that during this period of time there is underperformance. But we could have a reaccumulation and short-term underperformance by price in the reaccumulation, and it's still the price would go up. We also could have a situation where, let's say, the distribution is going to have a lot of strength characteristics, and only at the end of the distribution there's going to be some indication that the relative strength has changed. So again, quite a few variations that we probably would need to go through and to discuss. All right. Eric is asking, in the case of futures, for instance, grains versus canola, would we use the same comparative technique as we did with the currencies? Yes. Effectively, we would be looking at highly correlated instruments. For instance, I've used the same technique for gold and silver. You can use the same technique for any other metals. You could use this technique for, I've used it on my intraday level for index trading. When I was trading futures, I would define the bias for the day. I would define the index that would be stronger or weaker, and based on that, I would be directionally selecting a stronger in the uptrend and weaker in the downtrend instrument, and that would bring not just the profitability up, that would diminish my losses. Because think about, let's say, the behavior of two assets. One is stronger and then one is weaker. Let's say if our stop loss was somewhere here, if we are expecting the reaction of, let's say, the same size, let's say maybe like 10%, the second one might actually, just because of underperformance, hit that stop loss, whereas the stronger asset might have a more favorable reaction, and then the resumption of the trend, and the resumption of the trend. So from this perspective, the outperforming asset is going to outperform on the way up and on the way down, and therefore a sweet spot. Outperforming on the way down and underperforming on the way up. And this sequence suggests that there is a lot of selling on the way down and not a lot of buying on the way up. So what's going to happen with this asset at some point when such underperformance is going to be seen by other market participants, they're going to start dumping the stock. And as they dump the stock, they capitulate and they produce a lot of selling of this stock. Selling is going to accelerate the price to the downside, and we're going to see gaps, big spreads, big gaps on news that are going to be favorable or unfavorable. Reaction might be very unfavorable, doesn't matter. So you have to think of relative and comparative strength from an angle of institutional presence and participation. And hopefully this is the main message today that kind of lends into the discussion of what we're doing here. Okay, well, we talked about the sweet spot. Let's talk about the sweet spot a little bit more. So look at this example of Lulu. I'm comparing Lulu to triple Qs, that is the NASDAQ 100 ETF. Look into this area right here, a rally and the reaction. That the reaction is just very small. It's a high low, whereas the market is making a slope to the downside. So the stock is outperforming on both the rally and the pullback. What can we expect? Somebody's buying on the way up and somebody's not selling on the way down. Who could this be? Institution or institutions. So therefore, with their support, we're probably going to outperform in the next rally. And look at this next rally. We are overcoming the resistance, whereas the market overcame this resistance, but very late. So the stock is definitely performing much, much better. Again, why we're looking at this whole relative comparative analysis? Well, because it suggests that in the future, on the next run, the stock is going to outperform just because we've seen how institutions behaved at this spot. That's the whole key. We are not just want to be right, like being in the market. We want to be in the correct stock that's going to outperform the market. We want to choose something that is going to be more significant in the performance than the market itself. Look at the next sweet spot. Sweet spot. Up, down, up, down, up, down. So quite a different picture here again, where the market is creating short-term weakness and the stock is creating short-term strength, and that again suggests some kind of outperformance. Not a lot this time, but then the next one, look at how significant this discrepancy is between the market and the stock. The market is going down. The stock is trying to be flat and trying to create a definition of the uptrend. So already suggesting that somebody is buying as the market goes down. And we are definitely overcoming the previous high for the stock, whereas for the market, this is just an upthrust. Multiple closes above, but there is really only one close that is significant. Everything else after that is insignificant, even this close here. All right, let's look at the next sweet spot. What if we would look at the big rally and big reaction? Looking at this rally right here, we are seeing that it overcame the previous high, whereas the market actually did not do that. It went into the upthrust situation, but nothing else was there. And then look at the reaction. By the time we are making the low in Qs, we're already trying to get out of this trading range formation. So a lot of strength right here. There is a strength on the rally itself, overcoming the structure, overcoming the resistance for the stock, and then reaction comes to the level of the support, whereas for the market, we definitely see a much more meaningful reaction to the downside. In other words, here we are comparing significant low to another significant low, something that we've done with Adam at the beginning of the session. And then we're looking at the slope, and we see that the stock is so much stronger at this point. And that suggests multiple things. That outperformance suggests a good market long term, because we're looking at the long term sweet spot. So a significant outperformance right here on the way out. And hopefully we have the chart after that. If not, just go check it out. So this idea of the sweet spot was added to the knowledge probably like 7 years ago. And a lot of the students decided that they like this concept and they want to test it. And at the time I didn't have this opportunity, but then, some of them developed those type of tests, and this is what they've seen. So this is again the test from Howard Lask. He is one of our advanced students in our community, and he is the one who has been doing a lot of technical stuff, supporting all of those tables under the tools. So he decided to do the visual backtesting of the sweet spot concept. And he said, I want to look at the S&P, and I want to define all of the moves in the S&P, all of the swings that that had a reversal and are ready to go up. And Howard wanted to identify during the same period of time any type of trades that are going to be in the same direction. And he said, I'm going to use the sweet spot to see if the sweet spot is going to outperform. And as you could see, there is a lot of consistency as to how this type of performance actually suggests that whatever buying the institutions have had on the rally and then on the subsequent reaction, probably the next rally is still going to outperform. And we could see that it's only in 4 cases. This is where the sweet spot has not outperformed. And I think this is a really good result. And statistically, we are outperforming in some cases quite significantly. We have to look at exactly like why, what was in there, and so on and so forth. But still, I would say that we are just trying to get away from the statistical area, but it looks very promising. It looks really good. In a lot of the cases, when we observe a sweet spot, the next rally is going to be an outperforming rally. So in this strategy is something that you could add to your portfolio if you already have like a long-term strategy. And I was thinking about this today. Even though majority of our students are swing traders, I really would like to start developing long-term campaign type of discussions. So we'll talk about this more and more as we progress into the practicum. Coming back to the sweet spot. Again, this idea of the sequence of strength. A strength on the rally and subsequent strength on the reaction. And for the longest time, when I started using this concept for my own trading, it was really hard to follow this sequence. Sometimes the sequence would suggest that, oh yes, there is a lot of rallying, there is a lot of buying on the rally, but then reaction would come and it would be weaker. So it's definitely could be confusing, But at the same time, if we use this as a concept and we have some rules, guidelines around it, I think we could extract a very favorable information as to what we should select and when we should select it, especially for swing trading. All right. Okay, let's talk about filtering. Oh, I misspelled here. We still have about maybe like 15, 20 minutes. Let's talk about filtering and scanning tools. Well, here is our case study of Home Depot. This is the last slide. Remember, we had this trading range. And we said that we look at what the price has done. We looked at the relative strength ratio line, what it's done. And we are saying that it's probably a sign of strength in both cases. So we want to establish some other tools that could help us identify a change of behavior. And now think about this. We've talked about the change of behavior, change of character where? In the price structural analysis. Now we're talking about the same change of behavior in the comparative relative analysis. And obviously comparative relative analysis is all about the price behaviors as well. But still, all of those concepts could be applied on for the relative performance. So what other tools would we use? Well, we definitely want to use any type of heat maps. That should help you out as well. We want to look at the peers, meaning we want to look at the group and the peers in the group. So for the Home Depot, this was the home improvement retail group, and you can find that in stock charts. You could find this group in a lot of other softwares. And then for this group, we have two stocks, Home Depot and Lowe's. And let's look at the heat map. So the green is usually going to mean improvement. And here for the groups, we have 156 groups, I believe. So we went from 1 week on June 20th, 2014, from being one of the worst groups in the market, 132 at that point, and then in 1, 2, 3, 4, 5, 6, 7, 8, 9, in 9 weeks, we went to the top 10 group. I want you guys to see this because this is going to be a very important point here that we're making. Look at what has happened during this 9 weeks. The relative strength has improved. The comparative strength has improved. Well, where was it? Well, it was right here, and then the end of this 9 weeks was right here. So what happened was the price. The price went up. It overcame a long-term resistance and committed to the upside. So a significant move to the upside produced a significant rally on the relative strength. We could see that this was the relative strength rise right here. And we could see this in the heat map as well. So heat map is just another tool for us to visualize the same concept. But I want you to think about a heat map from a different perspective. When we look at the heat map, we usually would look at two numbers. We would look at the top performers, and then we would look at the rotation. So usually the top performers would define the stocks in the uptrend. And sometimes, students would complain, well, the stock is already like, with such big relative strength, it usually would mean that the stock is traveling up. It's in the uptrend. But rotation suggests a short-term outperformance. And the short-term outperformance could lead to a longer-term outperformance. And that's what we want to capture, a long-term outperformance. And then comparing it to the structural analysis, we said that this is a sign of strength on the relative strength. So there is some kind of 9-week rotation by institutions into this theme. This rotation defines the timing. This is where the price will start leaving the trading range and start traveling up in a trending manner. And we want to capture that moment, because this is going to be the moment when the trend is going to emerge, and we want to jump on that. Okay. Well, let's talk about the relative strength line ratio. How do we create it? This is from stock charts, Apple daily chart. And then at the bottom, under the indicators, you have to put price and then take the symbol of this stock, division column or division sign, and then a market proxy. You could also write something like this. You could write $ symbol, division sign, and then a market proxy. So for instance, I could say S&P 500, SPX. And then all of the charts, whatever symbol I'm going to enter there, automatically is going to create the relative strength ratio price line for that symbol in the S&P. And this is how it's going to look. It's going to look as like this black line. You could put this onto the chart, you could put it on the chart, and then in the advanced section, I'm going to put 2 moving averages, 52.13, and I probably would just change it a little bit here, but the moving average just basically, helps you to define the trend. So look at what happens here with Apple. We're in the distributional formation with the higher highs, higher lows. That was one of the questions about could we define by the relative strength the distribution? Well, look at the relative strength here. It's also in this upsloping structure. It's only when the relative strength started to deteriorate in a more significant way and the price did the same. That's when we could say that from a leadership characteristics, now the price, the behavior of the relative strength in the price suggests that we're going to have lower prices, deterioration of that leadership. And that's what has happened a lot in December with a lot of the outperforming stocks. Like I bring Novadear, we talked a lot about this. So it just the pattern where the leaders are going to be a flight to quality until the last push to the downside, and then they're going to capitulate right there. And then look at how the relative strength and the price confirm each other when the price starts to break out and the relative strength is breaking out as well. Breakout, 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 break to the downside, and the leadership changes as well. So if we would be long-term investors, we would be saying, okay, well, if this is an area of accumulation, I want to see the breakout of the price and the breakout of the relative strength, and follow this pattern until it's broken right here. So this could be our exit. So think about the long-term strategy where we are entering, let's say, at about 65 and we are exiting at about 120, and it takes maybe a year and a half to be in this position, and we are almost ×2 on this position. So we're probably making around 80% annual rate on this position. And we're just using such simple technique, confirmation of the price and the relative strength. And you could read more on this in the chart school. Go to the chart school of stock charts, and start searching, exploring relative strength. And you will see a lot of articles on that would suggest that the confirming signal between the price and the relative strength is an extremely valuable tool for us to define the emergence and the end of the trend. Actually, one of the homeworks is going to be based on this concept, next homework. Okay, now let's talk about our tools on wyckoffanalytics.com. Go into the indicators. I believe those are tools now, so you have to check it out. And use the password Wyckoff123. So obviously do not give it to anyone else. This is just for students. This page was created for our students only, and that was created by our student. I mentioned his name. And when we were looking at what we wanted to create, I said that it would be nice to also have some kind of research page where you could have the stock, like Apple here, see where it is from, which group, which sector, look at the chart, and then look at the group that it belongs to, look at the rotation in this group, and then look at the peers and be able to compare Apple to peers. So for instance, we would be looking at Apple has a rotation from 68 to 41, but then at the same time, Cray has a much larger rotation, where from 91 in 5 weeks, we are getting to the top 2 in the group. So that is so valuable. What else is valuable is that in this tool you could do this historically. You could go back and try looking at the relative rotation for the whole group or for the whole sector even, and then look at the peers and compare their charts. Because ultimately when you look at one chart, let's say you look at Apple, before you buy Apple or before you sell Apple, you have to look at other stocks in the same group. You might be missing something. Look at where Apple is. Even though there is a rotation, a really good rotation, but there are multiple stocks above Apple that are much stronger at this point of time. So we would have to think about what to choose from the peers as well. Maybe there are some better candidates that were available at that point of time. So use this page. It's updated each Friday, and please, keep this access confidential. There is another page under the same tools, navigational pattern. It's called the heat map. So we've talked about the heat map. Here we're basically exploring the top-down approach, where we look at the sectors first and we define the leadership in the same way. We define the leadership as the top leadership, so most likely this is going to be already in the uptrend, depending obviously on the market conditions. And then we also want to define the leadership as rotational leadership, coming from, let's say, 8 to 5, 7 to 4 in telecommunication services. So it's when we see this rotation, we're thinking institutions are coming into this space, into this area. So therefore, we need to look at this rally and make an assessment as to are there any candidates that would show the relative strength, show the correct structure, and show us the correct timing. So what we would do, and this is an example of where we would, what would we do here? This was consumer discretionary, right? And then we would look at the consumer discretionary and we would say, oh, okay, under the footwear, we see such a big rotation. Let's look at some of the stocks in the footwear. And looking at the top stock here, Skechers, also there is some very favorable rotation. And then just staying at the top of the leaderboard. So this is a selection process for us, where we identify the market bias first, then we go to the sector level and we say, yeah, I want to look either at the leadership or I want to look at the rotation. And then in that leadership or rotation, I want to find the group that's going to have the same characteristics, either leadership or rotation. Want to look through both of them, and then look at all of the peers, and again, define leadership or define, let's say, a rotation, and look at those charts. That's our process. We are using the concept of the relative strength as a filter mechanism to get to the stocks that are right away showing some presence of institutional activity. And then we start analyzing the structure, and then we start analyzing supply and demand. In a lot of cases, students ask me, well, can I do structural analysis first and then relative strength? You definitely can, but imagine that if you want to look through the whole market, then if you do the structure first, it's going to take you more time. All right, so use this for sure. Okay. Let's stop here. Yeah, 5:30. Let's stop here because I wanted to add something to the selection process. So this is just the intro for us as to how we look at the relative strength, how we look at the comparative strength analysis. This is the intro on the differences. This is the intro on the understanding why this is so important, why we need to understand that the stock is starting to outperform in the trading range and so on and so forth. I'm also showing you different tools, so I want you to get comfortable with those. So go to our website, use the password, play around with the heat map, play around with the research page, then go to stock charts, play around with the relative strength line, create one. I'm showing you how. And then do the homework. Don't forget, you have the homework. Here's the homework. 4 slides. Each slide has a market and 3 stocks. I'm giving you the bias for the next swing. You have to define which stock is not only going to go in the direction of that bias, but it's going to outperform either to the downside or to the upside. Doesn't really matter. We just want to see the outperformance over the market. And then we're going to start the next class with the review of this homework. And it's a lot of fun. This homework is usually a lot of fun for students at this point of time. And then in the next class, we're going to talk about the selection process, and we're going to be a little bit more deliberate as to how we actually get to the stocks that we want to look at. All right, guys. This is it for today, and I'll see you next week. Send me your homeworks. Thank you so much for being here, and have a wonderful week. Thank you, guys. Bye-bye.